Hi there, welcome to Kneppy Invest. Just finished taking the dogs for a 3.5 hour walk. They're all pooped out, sleeping right now. And I thought before I have a shower and get ready for the rest of the day, why not record another answer and reply video? If you haven't seen one of these videos before, I go through all the comments, all the questions you have left in my videos during the past week, and I answer or reply to those comments or questions. So let's get straight into it because over the past few weeks, this video has been about an hour and a half long. So hopefully I can limit it down to about 1 hour today. So let's go back to about 6 days ago. The last comment that I did not reply to, and this is from, in fact, I might just increase the size. So this is a question from Saji Vagis. Please see the stocks FRI, FCG, Sezzle, Nasdaq. Please advise I can keep it longer term. And then there was a reply to that comment saying, I can't give financial advice. No, it's absolutely true. In fact, none of us can give financial advice. It's absolutely illegal. Now, if you're talking about cryptocurrency, if you're talking about property, if you're talking about any sort of other investment, I could give you advice. But when it comes to the stock market, no, it is absolutely ridiculous. But that's the way it is. So I can't give you advice, but I can talk individual advice. But I can talk about these three companies. Fry, I believe, is Finbar. FCG, I have a feeling it's Freedom Care and Sezzle. So let's have a look at these three companies. Now, I don't know the ins and outs of these three companies, and I'm turning to become more of a technical analysis, that sort of thing. So what I'll do is I'll have a look at charts for all three, and then I'll just tell you if I like the charts or not like the charts. So let's have a start with, I think it's called Finbar. And I'm pretty sure Finbar, I could be mistaken, this is property development, something like that. You can just tell by trading view. Development of medium to high density residential apartments and commercial property. I wonder if trading view is ever wrong. So this company is what I thought it is. I'm pretty sure this company is in one of my watch lists, my buildings watch list. There it is. Anyway, so Finbar. And yeah, this actually doesn't look like a bad of a chart. This is just a daily chart. And things are looking okay for Finbar, just based off this simple chart. So without even knowing what's happening with the business, maybe the business is failing. I don't know. I'm just looking at the chart, and the chart does look positive. The one thing I'd like to see is higher volume coming in, and to be honest with you, share price hasn't really gone much in terms of price changes. So it's moving in the right direction. But if you just look this time last year, May last year, when the share price was nearly at its bottom, the share price was 61 cents. Now it's at 81 cents. So an okay return over the past year. But this is a shift in trend and a shift in sentiment in a company. Share price was in a downtrend, and now it's moving into an uptrend. Higher highs, higher lows. Definition of an uptrend. Now, in terms of the business itself, I'm just having a look here. So this is this is trading view, and revenue has been dropping the last 4 or 5 years. Company is profitable. Is the company dividend paying? I would assume so. Dividend, no dividend yield. PE ratio 41.3, markup 208 million. Just based off the chart, I wouldn't be too concerned because the share price is in an uptrend. But other than that, I have no idea about the business. Decrease in revenue would be concerning to me because that is one thing I do look at. In fact, it's the first thing I look at when I research a company is revenue. What is revenue doing? Now, that's not the only thing I look at. You also want to look at margins, cash flow, profitability, where the company has a moat, management, all those sort of things, if you're thinking about a long-term buy. But I wouldn't consider this company a high-quality company, so I'd just be trading it. At this point in time, maybe an okay trade, maybe a buy-the-dip situation, maybe. But even then, I wouldn't have that much interest in this company. The other company is FCG, which I believe is called Freedom Care. And I believe this company has something to do with NDIS. The chart looks... So straight away, I'm running for... Now, this is the problem with Trading View. Whenever there's a break in trading in a company, they just eliminate or delete that gap. So in fact, here's 2016, and all of a sudden we jumped to 2023. So there was a period of time when there was no trading in this company for, it's probably not the same company, it's a different company with the same ticker code. So for about 7 years, there was no trading. So in 16th of November 2016, a company with a ticker code FCG had a share price of 8 cents. And the next time this company was trading, this company, Freedom Care, was the 17th of October 2023, and the share price was 20 cents. So I'd say this company IPO'd on the ASX in October last year. So straight away, it has only been on the ASX for about 6.5 months. So we do have some financial information from this company. Now, chart-wise, nothing much to write home about just now. Share price is really going sideways, 18 cents. So it hasn't moved a lot. So I suppose that's a good thing. Share price hasn't nosedived like a lot of other IPOs on the ASX have done over the past few years. So FCG. Okay, so release of shares from escrow, investor presentation. At least they're marketing. And first thing I want to do, in fact, let's go back 1 year. So I can actually verify they did list on the ASX late last year, and yeah, they did. Here it is: ASX market release and emission and quotation, 28th of July. Have a look at their prospectus. And that's first things I will do or would do if I had a little bit more time. But let's just have a look at their half-year accounts, and then I'll have a look at their Appendix 4C. I could have a look at their investor presentation. Actually, might open that up too. So first thing I always have a look at when there is a company I don't know anything about is just their financial reports. So this company has revenue of 19, almost 20 million, but was not profitable. That might be okay. It's not necessarily a bad thing. Let's dig a little bit deeper. So spending $7 million on administration expenses, that's a fair bit. $6 million on employees, so $13.7 million just on administration and employee benefits, and then $4 million on office expenses. Okay. Assets, so total equity at 4.8 million. So even if the company is profitable, you're not going to see much profitability unless their return on equity is really substantial. And I don't think this business would be like that. And operating cash flow, operating cash flow positive by 1.9 million. So that is interesting. And that's why the cash on hand did grow, because they were operating cash flow and free cash flow positive. Let's have a look at their last Appendix 4C. In fact, they do tell us what they do. Yeah, NDIS service provider. Now, has been a lot of dodgy things happening in that space, hasn't there, been over the past year? Doesn't mean Freedom Care Group is dodgy at all. Maybe it's what they're doing, exactly why NDIS was set up. I would assume that this company is also highly dependent on government and regulations from government. So that could be an area you'd have to know a little bit about, whether there's going to be any changes in this area over the next few years. It could be beneficial for this company, or it could go in the completely opposite way, where there could be government regulations that are harmful to this company. That's another reason why I probably wouldn't be interested in this company. But let's just have a look at their Appendix 4C. So receipts customers 9.2 million, staff cost 2.6. Administration, why is administration and corporate costs so high for this company? $5.7 million in the quarter, and operating cash flow positive. This company is operating cash flow positive, 581,000. So I'm a little bit surprised this company hasn't really popped onto my radar, and I think the reason why it hasn't is simply because what they do, and I'm just not interested in what they do. But otherwise, if you are interested, things are looking okay for this company. It's just these administration costs. Why is it so high? There's probably a reason for it. And just have a look at their presentation here. So accommodation, allied health, all supports, competitive advantage. I'm not sure what sort of competitive advantages a company like this could have. Yeah, that's something that I think it would be very hard to show that you do have a competitive advantage. And I still think this company is going to be highly dependent on the government in future, and that government support could just be taken away at a moment's notice. And the last one was Sezzle. So this was on the ASX, wasn't it? And then did it delist, Sezzle? Did I spell that right? No, I did not. Sezzle. And I'm just going to look at the chart. This is another buy now, pay later. And sure, the chart looks really interesting, doesn't it? Heaps of volatility. Share price was as low as $8 in October, went to a high as $100. What's happening here? The volatility in this company is extreme. Then the share price went from 100 down to 44. Now it's back up to 84. They must have released something really positive on the 9th of May. Share price rose 76%. Don't know what that is. I'm not really following this company at all at this point in time, but the chart looks fine. And hopefully you bought in around $8 back in December last year. Hopefully. And that's all I'm going to talk about Sezzle. Not the sort of company I would be buying for the long term, but maybe just a trade. And thank you, big boy baby. What happened to NNG, which is Nexion? No idea what you're talking about. Let's have a look. NNG, Nexion, a company that's on the cusp, I think, of becoming operating cash flow positive or even free cash flow positive. Pennies for say did not make it onto my list of companies to do. Let's have a look at the list of companies. Here it is. NNG did not make it onto my list of companies to do a video on in relation to the March quarter pennies for say. Are you talking about the movement in share price? Share price. Oh, there's been no trading in this company since the 22nd of April. Suspension from quotation. Okay. Is this what you're talking about? Company has been suspended. I have no idea. So let's have a look at the trading hold. Why did the company go into a trading hold? Regarding a material acquisition. That sounds interesting. And more than likely, the reason they got into suspension is because they need more time in regards to this acquisition. That's what I'm assuming. Still regarding the material transaction. Okay, so this is not bad news. This is a material acquisition. Now, we don't know the particulars around this material acquisition, so we're going to have to wait. I'm surprised that it has taken a long time for this company, but they're still in suspension. It's not bad news at this point in time. If it was something in regards to funding or debt or something nefarious like that, I would be, well, you wouldn't be concerned because there's nothing you can do about it. Why be concerned if there's nothing you can do about it? But if I was a shareholder of this company, I would be a little bit excited, waiting for this news flow from the company. Otherwise, I won't have a look at their pennies for C because that's not the reason why they are suspended. Let's just have a look at the chart for this company because the company was on the cusp. And I think there was a little bit of news flow from this company beforehand. Share price rallied on pretty good volume 6 days leading up to this suspension. And was there any news flow before that? There was a price query from the ASX the next day after they were halted. I wonder if they mentioned anything in this. I reckon there is loose lips. I reckon there was rumors on the street about this acquisition. So, okay, this is a really interesting one because the company did release a price and volume query from the ASX. And the first question is always, do you have any information that could explain this price and volume increase that you not released to the market? Most of the times, I'd say 95% of the times, maybe even more than that, companies say no, and then they have to go past question 2 and go to question 3. In this case, Nexion said yes. Very rarely see a company saying yes to the first question. And they've said here, yes, Nexion is in the process of conducting a negotiation for material acquisition, remains at this stage as incomplete negotiation that is insufficiently definite to warrant disclosure. So definitely someone knew about this potential acquisition. And that's probably why they went into a trading hold. Yeah. So very interesting happenings with Nexion Group. Market, or someone knew about it, share price going sideways, share price popped up. ASX said, wait, what's happening here? Company went into a trading hold, and it's just taking a while for this acquisition to get through. It may never get through. Maybe this rumors, or maybe these, whatever you want to call it, this news of this material but possible acquisition means the acquisition never comes to fruition. Who knows? But there's nothing you can do about it now. Nothing anyone can do about it. So that's what's happened to Nexion. No idea that was happening. Thank you for that question. Ryan Corrupt. Hi, Kneppy. Have you ever spoken about GQG? Yes, I have spoken a lot about GQG. What do you think about it? Thank you for all your fantastic work. I'm trading GQ. I always have difficulty saying this one. I am trading GQG right now. It's not my favorite type of business. I don't like, and it's also American based, isn't it? So GQG Partners is some sort of fund manager. Provision of investment services through a subsidiary, mutual funds and other structures, including pooled investment vehicles. And I'm pretty sure it's headquartered in Fort Lauderdale. So in Miami, we'll say. Now I'm trading this, and this is a beautiful looking chart. That's why I'm trading it. So I'm in this for as long as the trend plays out. So this is, and this company listed, or fund manager listed back in 2021, and the share price went sideways for a long time, and then just a beautiful breakout. The breakout really happened back in January at $1.70. Current share price is $2.50 or $2.44, and the trend is still in play. And that's all I can really say about this company. I'm just trading it right now because the chart looks absolutely stunning. Beautiful looking chart. And that's all I'm going to say. The rest of it, the company, yeah. I did get asked about GQG a while ago because the structure of the company or something, I forget exactly why, if you do invest in this company, you might get one of those forms from America for taxation reasons. But because I bought this company through Superhero, I didn't get that. Big Boy Baby says, will I watch the 2024 Berkshire annual meeting? The quick question, or the answer to that is no. Now, I think there is a definite argument that the Berkshire annual meeting, Warren Buffett, are a little bit overrated. But in saying that, they do on occasion have some good insights. So I think the meeting would be like over 6 hours long, based off what I have seen in the past. And I just don't have the time to go through the meeting. I prefer to read or listen to something that wraps it up in like 10 minutes or so. But I mean, if people go through what Warren Buffett has said in the past, I think there's no problems with that. I think you can learn a fair bit. They do have some really good insights on occasion. But I do think too many people put Warren Buffett, Charlie Munger on a pedestal. And yeah, they're okay, but they're not. There are some investment fund managers out there who have done better than Warren Buffett in the past, but they're not really on a pedestal. In fact, Peter Lynch, by far, I think, outperformed Warren Buffett, but he only had a fund, what was it, for like 10, 15 years, something ridiculous like that. So Peter Lynch also wrote one of the best books, Peter Lynch. There he goes. I'm trying to remember how long, yeah. So one up on Wall Street, 1989. So he ran his fund for 13 years between 1977 and 1990, averaged a 29.2% annual return during that period, which is significantly better than Warren Buffett. And I think, yeah, I think he a little bit different. Peter Lynch got out really early, and if he stayed in this fund, I think he could have grown this fund to an amazing level. But that's the thing that Warren Buffett has over many other fund managers. He stayed in there. He stayed investing. He's over 90 years old now. And, that's the big difference between him and other fund managers. They get out when they're maybe 60 or 70 or maybe even older. And he also started a little bit earlier as well. But, yeah, Peter Lynch is one of my favorite fund managers. Yeah. 29.2% annual return per year over a 13-year period. And then I'm trying to remember what he did. During his 13-year tenure, assets under management increased from 18 million to 14 billion. And his book, One Up on Wall Street, is one of the essential reads, in my opinion. And look at this. From 1977 until 1990, the Magellan fund that he ran averaged 29.2%. And as of 2003, had the best 20-year return of any mutual fund ever. Now, if people put Peter Lynch on pedestal, I could understand that. Great investment. Great investor. And you can see that when you just read his books. Yeah. Anyway, that's P. Lynch, still alive. 1944. Same age as my dad. There you go. Anyway, yeah, I will never go to a Berkshire annual meeting. I just think it's more of a cult than anything. And I say that in a bad way, don't I? Why no Clarity Pharmaceuticals? Looks like a breakout with volume. Well, I mean, I could have, but I've been looking and talking about Clarity Pharmaceuticals for a long time. And you're right. Clarity Pharmaceuticals had a breakout. Yeah, I think there's a little bit too much FOMO with Clarity Pharmaceuticals right now. The market cap of the company is over $1 billion. So I do think there's a little bit too much froth in this company right now. But I think there is reasons behind that. But this is a fabulous looking chart. And to be honest with you, based off my how I'm shifting how the way I invest or trade, I probably would have traded this. I probably would be in this. And this is one of the reasons why I'm shifting the way I invest. Because I stayed out of this on purpose because it's more of a story stock. I was going to invest in Clarity because it is a hedge against Telix Pharmaceuticals. They're not trying the same things, but there is potential that Clarity Pharmaceuticals will supersede Telix in what they're doing. It could be the better product in the end, but Clarity Pharmaceuticals still has a long time to go before it gets to profitability. So still a story stock, but the chart looks absolutely stunning, and I'd be definitely in this. Wouldn't be surprised to see a little bit of a pullback. And I could think about buying shares if the share price pulled back to say 3 to 320. I definitely think about buying some shares, but not right now. Okay. Oh, there's likes. Thank you. You're welcome. So we're getting into Mayfield Group. I did a video on Mayfield Group, bought some shares. This was not a recommendation. Someone asked me about it. I should look at it. And I didn't realize there was a company called Mayfield Group. I knew there was a company called Mayfield Education. And then I had a look at it and went, this is the sort of company I am looking for. Yeah. So there's quite a few replies in regards to that company here. Okay, Black Top Images. Don't know much about exploration drillers, but comparing Westgold to West Africa, it looks like Westgold is in a better position. No idea about who's in a better position. You'd have to probably know both companies really well to really determine that. But I'm seeing a lot more volatility in Westgold over West Africa. Now, I do know West African will have another mine coming online in a few years, and their production will grow significantly. West Africa is in Burkina Faso. I do know that. Not sure about Westgold. So let's have a look at Westgold and West Africa. Now, I'll just have a quick look at Westgold, where they have operations. I'm assuming it's in Africa. That's why you're comparing the two companies. So let's have a look. Which one? Let's have a look at the investor update, maybe. Oh, this is going to take ages because it's freaking ComSec. I'm going to just show you how bad ComSec is. I'll try to open this via market index. GX. We'll get to the announcements, investor update. It's open straight away. And ComSec's still opening. It's ComSec. It's not this computer. It's not my internet. My really quick internet is just ComSec. And yeah, I don't know why. You'd think ComSec would have really good capabilities, but it's lacking in so many ways. But still, in my opinion, the best platform because of still opening. I just can't believe it's still opening. Okay, so where do they have operations? Based off this, without even knowing, it looks like they have operations in Australia. Is that right? Here we go. Operations Briar and Murchison. It's not telling me where it is. I'm assuming this is in Australia. I love a map. Here's a map. That's in WA. Okay. So I'm assuming they have operations in WA as well. I'm not sure. Yeah, Australian gold producer. All right, so I don't know as much about Westgold, and for many of these, there it is, it's open up now. So for a lot of these companies, I would compare all-in sustaining costs. Also have a look at the projected levels of output over the next 5 to 10 years, lifelines, stuff like that. So let's have a look at both charts. So and when I do all that, I'll just have a look at both charts. Which one looks bullish? I know West African looks really good because I do own West African, by the way. And this chart looks really good. I do think this company is undervalued because of the implied geopolitical risk in Burkina Faso. So this company does look really cheap. It says a P/E ratio of 9.83. But again, as I mentioned, they're going to have another mine online within the next, I'm thinking 2 or 3 years. It might be a little bit before that or might be a little bit after that. But the chart looks really good looking chart. So let's have a look at Westgold and just compare the charts. So West African looks good. It's just broken out as well. And Westgold, I wouldn't complain about Westgold either. In fact, in the longer term, this looks actually even better because it's been in an uptrend for a longer period of time than West African. And West African has gone on a really strong tear in a short period of time. The other thing I like to see is increasing volume. We've seen increasing volume in Westgold. I didn't have a look at volume for West African, but I'm assuming it's okay volume as well. Yeah, pretty good volume as well. So overall, chart-wise, I wouldn't. Let's have a look at some of the financial metrics with Westgold. You'd expect there's a little bit more of a premium for this company if they have operations in Australia. And it says, and this is a really rough comparison doing price earnings. 16, they do have a dividend yield, but it's fairly small. Market $1 billion. West African's like 1.5 billion. So yeah, other than that, I don't know whether Westgold is in a stronger position at all. No idea. But the chart looks actually really good. I like the chart for Westgold. I'm pretty sure Westgold's in my gold. Yes, it's in my gold watch list. Yeah, so other than that, my thoughts, yeah, I have no idea which is in a better position. I think you have to know both companies really well in depth to know which one's in a better position. Okay. Mayfield Group, Extian Turk Table. At 87 cents, this is for Mayfield Group. It looks a bit expensive by historical standards, and manufacturing capacity appears possibly constrained. That is a little bit of a short-term concern, but I wouldn't be surprised if some of the results maybe this year disappoint because they're investing for the future to increase their manufacturing capacity. And my one concern is many investors are very short-term focused. But if they are expanding the manufacturing capacity, if they're seeing growing demand for what they're doing, that can be only beneficial for the company in the long term. So I think there is potential that in the short term, you might see limited growth, but in the long term, what they're doing looks pretty beneficial. And one of the reasons why a company like this might list on the ASX is for better capabilities to grow in the future. Otherwise, why would you list? So I think one of the reasons this company is listing is to grow. So I think there is potential for this company to be a multi-bagger in the future because it's not that expensive. So you say it looks a bit expensive by historical standards, but you don't have much to compare it to right now. And just based off what I'm seeing right now, just the P ratio right now, it's actually fairly cheap. So I'd say this is actually fairly cheap. And if they can achieve their goals, and if what they say is right, there is growing demand for what they're doing, there is potential for this company to be significantly bigger in the future. It might not happen in the next 3, 6 months or even a year, but I think in 3 or 4 years, this could be a much bigger company than it is now. Okay, so that's a few other comments in regards to Mayfield Group. MicroX, this is from Luca Brasi. MicroX down horrible. Go the Buffalo Bills. Eventually one year they will win the Super Bowl. I'm not sure if this is the year, but who knows? You never know. So let's have a look at MicroX. A company I did a video on quite a few years ago, but they've never shown me they have a proven model, a business model. And what did happen? They must have released, this was in April, so I'm assuming they released their pennies 4C and the market didn't like it. So share price collapsed on Wednesday, the 17th of April. Chart is absolutely ugly. This is an ugly chart. No reason to even think about buying this company right now. just be on. What I would do if I do like the potential of this company, I would just stay on the sidelines right now and just wait for sentiment to shift. That's probably one of the biggest mistakes I've made in the past. I would like a company, get in, even if the sentiment is negative, and just see the share price of the company continue to drop. And then keep on watching that company for years and years before it does anything. And sometimes they do nothing. And I'm still waiting for some of those companies to turn around, but I'm no longer a shareholder because I've sold out. Anyway, so that could be what's happening with MicroX. So let's have a look at their most recent appendix 4C. I'm assuming it was the 16th or 17th of April. Oh, no, it wasn't the appendix 4C. They did a capital raising. And there it is. Capital raising. So I'm assuming the share price was at around about 12 cents before they did a capital raising. And since the share price fell to about 9 cents, I'd say the capital raising was around about 9. I'm going to say right now about 9 to 9.5 cents. So let's have a look at the capital raising and see if the raising was done at 9 to 9.5 cents. Again, CommSec, oh, look at it, how slow it is. Why did I shut out of a market index? It's pretty sad that I have to go to market index to get all these announcements. And there it is. We'll just open up in a new tab. And it's opened up again before CommSec. Okay, 9.5 cents. There you go. So proposes to undertake to a share purchase plan to raise approximately $1 million at 9.5 cents after the placement, which $4 million placement at 9.5 cents. So it's a little bit concerning the share price has gone below 9.5 cents. So it's really amazing that just based on the share price action, you can see what sort of share price the capital raising is done at. And because it's been done at 9.5 cents and now the share price is below that, I think the market has reacted to this a little bit more negatively. If it was done at 9 cents, the share price is at 9 cents, that's okay. But that's why the share price is down a fair bit. It's just a capital raising. And let's just have a quick look at their appendix 4C. And I don't think this was not a quarter that filled me with much promise just by looking at the appendix 4C, the section 1. So cash receipts, 819,000. 9 months to date, 5.7 million, but burned through $2.8 million of cash in this particular quarter. So still a long way to go for this company to prove to me that they are a viable business moving forward. They have a viable business model. And just look at the weekly chart. It's an ugly weekly chart, all-time lows. Okay, so staying on the sidelines with MicroX just now, I'm just waiting for a signal from the company. They have achieved their goals. Or looking like they might start to achieve their goals. Can someone please tell me the company? Sounds like no, it's IPD Group. Absolutely right, IPD Group. It is confusing. IPD Group, ticker code IPG. I always think it's IPG Group. Then I have to think no. ImpediMed has a ticker code IPD, so IPD Group can't get the ticker code IPD because it's taken by another company. So they went with IPG, which is IP. Miss out the D, group, the G in the group, IPG. I'm pretty sure there's another question about IPG group somewhere in here, or IPD group somewhere in the questions here. Okay, another one about Mayfield Group. This was a popular video. I should do more company or more videos like this. I wasn't going to do Vection Technologies, but I'm going to do a short standalone video on their appendix 4C. So I'm not sure what my next video in this series will be, small caps to buy, but hopefully it'll have just be as popular as Mayfield Group. So Ruben KHJ says, I think looking at the books, it does have a good return of capital employed, especially growing double digit. This is a good sign for long term or even a multi-bag of stock. I probably would agree with that. So there's a lot of different metrics along those lines of return of capital employed, return. Some people like return of equity. That's fairly simple. Some people look at return of assets, return of invested capital, return of capital employed. Some people even look at incremental return of capital employed, stuff like that. But these are good signs when you do have a high return of capital employed, return on invested capital, return on equity. If those are double digits and growing, that's a really good sign of a significant potential growth in a business. In fact, if I had to choose one metric and only one metric, so ignore every other metric, including revenue growth, earnings per share, P ratio, I would choose one of these. I'm not sure exactly which one. Don't have a favorite between the 4 or 5. More than likely, it'd be between return on capital employed, return on invested capital, return on equity, or return on capital. I'm not sure which one. So what you can do, go to this. I like FinChat. So let's have a look at MYG. There's not much information because Mayfield Group hasn't been on the ASX too long. And in Mayfield Group, or in FinChat, they look at 5 years averages of return on assets, return on total assets, return on equity, return on capital employed, and return on invested capital. Here it is. This is the section I like to look at. But they also have margins. I love margins, particularly gross margins. And I just like the way they've set it out. Valuation, PE ratio, price to book, EV to sales, EV to EBITDA, price to free cash flow, EV to gross profit, EV to EBITDA, price to free cash flow, which is one I like. Already mentioned those. Growth, revenue growth, earnings per share growth, EBITDA growth, dividends per share growth. I'd like to see revenue per share growth. I do prefer that, but I love FinChat. So let's have a look at a very big company, Microsoft. In fact, you can do this for all companies. So this is some of the numbers, the metrics, I don't know what you call it, if profitability efficiency metrics. So return assets, 18.6%. Return on equity, 43%. Return on capital employed, 28%. And return on invested capital, 29%. That is the sort of things you're looking for in a company to own for the long term. Another company, let's have a look at NVIDIA. Pretty sure NVIDIA would be pretty good as well. So up there, above 25% for all 4. In fact, return on invested capital is at 48%. So there is a much better chance that NVIDIA is going to have significant growth in the future because of those sort of profitability efficiency metrics. And probably the best way to look at return on, say, equity is, say I had 2 friends and I gave both friends $1 million. I said, do whatever you want with that $1 million, but come back to me in 1 year with your profits. And so they came back to me the next year with their profits. And one of them said, oh, I have $100,000 for you. And the other one said, I got $1,000 for you. Which one would you choose? You'd choose the one with, what did I say, $100,000 profit? That $100,000 profit on a $1 million, that $1 million is equity. That $100,000 is return. So the return on equity is 10%. The other person has return equity of, what was it, 1%. What would you choose? You'd choose a one with 10% because that's the return on the equity you've given them. And so what you can do then is say, well, you've done really well in the past year, so I'm going to give you back that $100,000. So now you've got $1.1 million of equity. Now do the same thing again. And then next year, they come back and said, yep, I've now got $110,000 of profit. So now you got $1.2 million. That other person, that other friend who only made $1,000 profit or whatever it was, you're probably going to say, well, I'm just going to take that $1,000 and just spend money on that because you're very inefficient. You did not give me good returns. That's a pretty weak return. That's the way to look at return on equity, in my opinion. That's the best way. Probably the simplest way is, what's the sort of return you're getting on the equity in the business? So return equity is the simplest one. Return on capital employed and return on invested capital, a little bit more difficult, but they're all in the same ballpark. And if I had to choose one metric to look at, and only one, it would be one of these profitability efficiency metrics, because it can tell you a lot about the company. And you'll see, if you looked at all the best companies in the world that all have really high valuation metrics, not valuation metrics, profitability efficiency metrics like return on equity, they all have really high levels. Just do it. Do it in your spare time. You'll see. Anyway, so back to MYG. When I look at these profitability metrics, it's not 1 year. You like to look at least 5 years. Just look at the history. And that's the problem with Mayfield Group is we don't have a big history because they recently listed. But according to this 5-year average, I'm not sure how accurate that is, return equity is 10.9. Return on capital employed, according to this, is 1.6%, but I'm not sure how accurate that is. I wouldn't be looking at that and making any judgments based off that. And there's another reason why there are some investors out there. So if you do listen to Ausbiz The Call, you'll note that what's those investors called? Team Invests. They want at least 5 to 10 years of history. In fact, they prefer 10 years of history because that's how they judge a company. They need a long time to look at these sort of metrics. And they love, if you listen to Howard, his name Howard Coleman, he just spouts return on equity for every single company. So this company has had return equity above 10% in the last 9 years. It's a great company. That's exactly what you want to see. And there's some truth to that. You want to see a really good return on equity for all companies that you invest in for the long term, because there's more likelihood those companies are going to give you a really good return over the next 5 to 10 years if they maintain those sort of profitability metric numbers. Oh, yeah. And yeah, so Ruben's absolutely right. If a company does have a really good return to capital employed, that's a really good sign for long-term or even a multi-bag stock. But again, I think with Mayfield Group, we have to be careful because they have been listed for too long. Nathan Rush says, my question was to do with the trading view indicators you have on your charts. However, since you mentioned it, it might be how to do a beginner's guide. I should do that, shouldn't I? On what you look for companies. It's really easy, I think, to do that. In fact, I just mentioned it, going on that rant about return on equity, return on invested capital, return on capital employed. So let's have a look at my trading view indicators. It's very simple. The funny thing is I've been looking at in the past rate of change, which is something that will just pop up here. There it is. And I've been looking at, well, can I use this? Probably not, because I just implied a lot of this. So rate of change is just looking at a period. So I think the period, the auto period is 20 days. So it looks at the share price movement in the past 20 days. So the share price has gone up 10%. It comes in as 10. And then just does this every single day. That's why you see it oscillate. And it just says, well, if it's above 0, the trend is up. If it's below 0, consistently, the trend is down. So for Micro X here, it's been below 0 most of the time, but it's been oscillating above and below 0 for a while, which means there's not much of a trend here. So if you go to another company with a trend, which let's go to Supply Network, you see their rate of change is above 0 for most of the time. Now that's on a 20. I wouldn't like a 20 because you're going to get a lot more volatility here. But if you change it to 100, I'd change it. Oh, it's 9. So it's even worse. If I change it to 100, not 1,000, 100, you'd see the rate of change for Supply Network is always above 1. Now, when you see it dip below 0, like here and here, that could be a buy the dip opportunity. So I think that's the way to look at rate of change is possible buy the dip situations for trends, or the opposite. If a trend is down, sort of sell on or if you're short, sell more when there's a dead cat bounce. I think if you did that with Supply Network, you would have done really well. You would have bought here when it's dipped below 0, right here. You would have bought about here, which you would have done fairly well. Now, to be honest, you would have done fairly well with this company no matter when you bought, because this is a beautiful uptrend. Okay, so let's go back. I'm on a bit of a tangent there. So I have been looking at rate of change, but I only have 3 indicators on here that you really need to know. The first is volume. I will always have volume when I look at a chart. Always. It's it's not the most important thing, but I think it's the most underrated thing when it comes to chart. What's a good company? PayPal? No, what's a good company? Let's look at Doug. Why not? I'm not sure if Doug's a good example. No, Doug's not a good example. Let's have a look at Pro Medicus. And let's go back in time, a long time. It's a long time, to about 2014 or so. So if you go to Pro Medicus and we go back to 2013-14, share price or the shares in this company were illiquidly traded. And what you want to see is increasing volume as you go through time. And that's exactly what has happened to Pro Medicus. Volume has increased as we go through time. And now the shares are definitely not illiquidly traded. They're highly traded. And we have seen that consistently, pretty high amount of shares traded on a daily basis. So volume is very important because it can tell you a lot about the psychology of the market around that company. So, for example, when a share price is in an uptrend, you want to see volume actually increasing. If you start to see volume decreasing in an uptrend, that tells you there's less strength in the uptrend. On the flip side, when the share price is in a downtrend, you want to see the volume actually decrease. So the volume should move in the way of the trend. And if you start to see volume increasing as share price falls, that's a sign that the trend could be finishing, or maybe not finishing, but there might be a bounce. Perfect example of this is People In, and I did exactly this. So share price is in a downtrend. Now, where was it? It was right here. Share price in a well-defined downtrend, and then all of a sudden the volume just popped up around about the 7th of December. That really piqued my interest. The other thing that piqued my interest is where the share price was, just above $1. And there was massive volume on the 11th of December. And I took a short-term trade. I thought there's going to be a bounce here. Just because of the volume and where the share price was, $1, very important psychological level. And the share price bounced. It went from $1, then I sold $1.20. Share price went all the way back up to about $1.40. And look where the share price is now. Doesn't mean that's the end of the trend necessarily, but don't be surprised if there's a bounce. And that's exactly what's happened. And you can see what's happening now with the volume. Very weak volume, very low volume. There's no one interested in People In. The reason why volume is important is it's just telling you someone's interested in this company. Someone is buying. More increase in interest means there's going to be a chance of some interest, some buying continuing that should push the share price up. It's all about supply and demand. And right now, there's just no demand for shares in People In. That's why the share price keeps on falling. And what's happening is investors in this company see the share price falling and they add supply of shares to the market. And there's not enough demand to meet that supply. That's why the share price falls. What this company needs is something to turn around sentiment, something to get people interested in the company. The best way to do that is good financial information. Now, eventually, I think if that doesn't happen, the share price of this company will just start going sideways, because eventually most of the shareholders who want to get out have already got out. I think there's also a value element to this. I think the more it falls, there's more chance that value investors will see value in this company, and there is a chance eventually the share price will start going sideways. And even then, what the company needs to release is a positive financial information. So volume is very important. Always have a look at volume. Never will I exclude volume. The other thing I look at, and I've got here, is 2 volume channels or ribbons. I don't know what you would call it. Now, I started using this, and then I noticed there's a guy called Carl Capolingio. He does have a series on, I think it was on Twitter, I saw it, and I'll just show you what he uses. Very similar to what I use, and we did this independently, which is amazing. Well, I think it's amazing. So this is what he used, very similar than what I use, but his color scheme is a little bit different, and he changes colors depending on the share price is, but very similar to what I use. I actually do stick to what I use just because I've been using it for a while. And all it is 4 different moving averages. And so for the top one, which is a longer term moving average channel, and the bottom one here, so the top one has the blue line in the middle. That's a 150-day moving average. So we're looking at 200, 100-day moving average. So that's sort of like the long-term investors. So it's a longer-term trend. That's the best way to look at it. The shorter-term moving average channel is a short-term trend. So that's more like the short-term, medium-term traders. And you'll see the color change based off the trend. For instance, we'll go back to Doug, since I've already brought it up once. So that you see, if we go back in time, so this is different cover, different colors. Green, it's in an uptrend, well-defined uptrend, Doug Technologies, but it shifted. So Doug Technologies back in 2022 was in a well-defined downtrend. And look at the shift in sentiment and the change in trend. And that's when I bought some shares at 83 cents. I was a little bit late to the party. The breakout occurred about 60, 62 cents. Bought at 83 cents. And look at the volume, very weak volume. During this period here from July through to the end of year 2022, no volume at all. And then we started to see some spikes in volume as a trend started to go up. And we have seen not massive volume coming in, but enough volume to keep the trend up. And so this trend is still very positive, 83 cents. I should not have taken profits in this company. I didn't completely sell out, but I did take profits at $2.50 back here. And there's no reason why I should have done that in hindsight. So that's the moving averages, so the channels. So it's 100 to 200 with the blue line in the middle. That's 150-day moving average. And the other channel is 25 to 50. And I can just by pattern recognition, I can just end. The other thing I do is I love putting resistance and support lines on it. That's dashed lines. So this is a dashed line here, which was a resistance level. And I want to see that breakout. What's another company here? So let's have a look at a company I'm trading, technical portfolio. Let's have a look at Sezzle. Why not? Well, we have to go forward in time. There we go. So I've got two lines here. So the first line was this line here. So there was initial line here. So you can see the share price of Sezzle was in a downtrend. So you can see a bit of choppiness here back in start of 2022. No trend there. So sort of a neutral trend. Share price went back into a downtrend in September 2022. Share price went all the way down to about 60 cents or so. And then we saw a little bit of breakout right here. Why is this a breakout? Share price was really struggling at getting above this level, which is about 71 cents. You can just see it. Share price moved into the longer term moving average channel, and these channels can be support and resistance. I see that a lot. Doesn't mean they're always support and resistance, but they can. And what I'm looking for here is I want to see these highs broken. It did it on 8th of June 2023. And we started to see the short-term moving average channel start to go up as well. And then the share price got to 80 cents, and that's when I bought. So again, a little bit late to the party. Bought at 81 cents, and then I was really, I suppose, really patient with this company. Share price just grinding slowly higher for the longest time, as Billy Joel would say. I put a little bit of a support level here at about 79 cents. So if the share price fell below 79 cents, I would have sold. It briefly fell below 79 cents on the 3rd of November, but I didn't sell because the share price briefly fell below that level during the day, intraday, but then rose back up above it. That's one of the reasons why I don't use a stop loss. I would have been stopped out of that company if I had a stop loss, say, at 77 cents. And I don't want that to happen. But the share price kept on just creeping, gradually climbing. And I was thinking of selling, but I kept saying to myself, there's no reason to sell this just yet. Just be patient. And then the company released their results in February. And look at the volume. Look at the volume. Telltale sign. And the share price action. So share price action and volume tells you a lot. The market loved it. And that's why the share price just zoomed higher. And again, I'm back to the point where I probably want to take profits, but I'm just looking at the chart saying there's no reason to take profits. I do have a little stop loss here. And this is not a stop loss in the market. This is just telling me if I do see the share price struggling and go below $1.20, I probably should take profits in this company. Because that's a little bit of a significant level. Share price was remaining or stayed above $1.20 for about 2 weeks here. So it is an important level. Okay, so I'm rounding on a little bit. So those are the things I look at. I like simplicity. So I have been looking at some other indicators here. So rate of change, RSI. I do look at RSI on occasion, but not all the time. Some other MACD, I sometimes look at that, but not all the time. Bollinger Bands, I sometimes look at that, but not all the time. But these are the things I look at all the time. Now, it took me a long time to find what moving average I want to use, and this is what I found in the end. This is what worked for me. That's the most important thing. Find out what works for you. So thank you, Nathan Rush. Big Boy Baby says, do I still have an active position in DGL? Yes, I do. Okay, so right now, the vast majority, in fact, I'm not sure I'll be able to show you this because I don't have it No, I won't show you this. I might show this in another video. So right now in my technical portfolio, my worst position, the only position down significant amount of money is DGL. It's at 60 cents right now. Now, this was a bad trade. This is, and again, the way you learn is to make bad trades and learn from it, but I've not sold out of this position. And there's actually a reason why. So I bought on this potential breakout. I thought, oh, look like it's breaking out. Share price has been a long-term downtrend. I think this is a potential breakout. But then the company released something really negative on the 27th of February, so it must have been results. Share price plunged all the way to 60 cents. I actually bought some at 60 cents because I thought the market was overreacting. And then on the 14th of March, the company actually did release something positive. And based off this positive announcement, I think the company is potentially significantly undervalued. And I just think now is not the time to sell at 60 cents. I think this is a case where the company might release a profit upgrade. I think the chances of profit upgrade are probably more or higher than the chances of a profit downgrade. That's what I'm thinking right now. So I am down about 20% in this because I did average down at 60 cents, which I don't recommend. I think average down is fraught with massive amount of danger. And I'm just a little bit tentative because based off my rules, I should have sold out of this position. Just take the loss and put my money to work elsewhere. But I think this has the potential to be actually a really good trade in the future. But I think it might be more of a longer term trade. Fairly similar to what happened with Gentrack about 4 years ago. I was in that for about a year, maybe even 2 years before it finally broke out. But there is an opportunity cost if you do go down that route. But I am still in DGL and don't think I will sell just yet because I think there is still really good value unless they do release a profit downgrade and the share price could collapse even more. And then, okay, talking about Doug, what are your thoughts on Doug? And Jenks is absolutely right. They released an update the other day and it's fine. The company is looking really good. When was that update? It was maybe a week ago. Doug Technology update, the 1st of May. So 10 days ago. And I looked at it and went, yeah, there's no reason to even think about selling this company now. Now, I did sell or take profits. So nice increases and everything. I didn't completely sell out. I sold out of 2/3 of my position and maintained another third. And to be honest with you, this was a mistake. There was no reason for me to sell. Here's the chart. I sold up here, 250. So, and then share prices kept on running. There's no reason for me to sell. I'm looking at this going, why did I sell? I just took profits. The chart is this is a beautiful looking chart. I have a feeling I sold because I bought at 83 cents and 250 was a triple bag. And I went, why not take some of those profits and put that money to work in other, but yeah, there's no reason to sell. And I did watch a video on self-wealth. I will show you or give a link to that video. And that person showed us, the viewer, their portfolio. And they had some positions in that portfolio that they held for many, many years. This is a trading portfolio, trader, and he's held positions for many, many years, including MA Offshore. I'm pretty sure he owns Doug, and he's held it for, in fact, he bought most of his positions that I've also traded. He bought after I bought. So it looks like I get in earlier than he does, but I tend to sell when I probably shouldn't sell. So I take profits probably too early. That's what I'm thinking now. That's my lesson, I think, moving forward. And there's no reason I should have taken profits with Doug. No reason. Chart looks absolutely stunning. For a dog. G slide 9 says, interesting to see the flow of effects to competitors as a result of these announcements. So we're talking about SXE or Southern Cross Electrical Engineering. Southern, what's it called? Southern, I forget what it's called, SXE. Anyway, so that company had a really good announcement. Share price rose 20%. Another company called Tourism Holdings released a really, really negative announcement. Share price dropped, what was it, 37%. Camplify, I did not realize this until this morning, or actually last night. Camplify share price plunged on the back of tourism holdings, but IPD Group did not rally on the back of Southern Cross Electrical Engineering's important announcement. In fact, I'll have a look at all 4 charts, I suppose, and he's saying it's just puzzling how the market has reacted. And I'd say, yes, I am puzzled what's happening with IPD Group. So let's have a look at all 4 charts. Let's start with tourism holdings. I mentioned that tourism holdings was on my watch list because share price was in a downtrend. The market got this absolutely right. Now, the company is aiming for $100 million of profit in two or 3 years. Current market cap of this company is 397. So if they do achieve profit of $100 million, this company is trading on a P ratio of below 4, a forward-looking P ratio of below 4. But the market is telling us, or telling them, there's no way you are going to achieve that. And the share price is, or the chart looks absolutely horrible. No K bounce, but nothing spectacular. And then if you have a look at Camplify, so Tourism Holding have, like they bought Apollo Tourism, which have camper vans, that sort of thing. And Camplify is sort of like a travel van, tourist van marketplace, whatever you want to call it. I have really no interest in companies like this, but look at the share price has plunged. In fact, this is an ugly looking chart. Yeah, probably oversold, but it's looking ugly for Camplify. Now, on the flip side, and it's all about sentiment and headwinds and tailwinds. So it's more about headwinds and tailwinds, right? So a lot of headwinds for tourism holdings and Camplify, but for Southern Cross Electrical Engineering, a lot of tailwinds behind this company, significant tailwinds behind this company, and you'll be able to see that in the chart. And those tailwinds are coming to fruition. So an absolutely spectacular chart. Share price increased on Friday. Nice little increase, up 5%. Not surprising, there was a little bit of selling on the back of this announcement. So I bought it at $1. So I've been following this company for a while. Share price in a beautiful uptrend. In fact, it's been an uptrend since probably, I'd say about August. So you could have bought this at 70 cents. In fact, that was a breakout at 70 cents. But it took me a long time to take a position in this company because of a little bit of biases towards these sort of companies. And then I just saw this breakout on the 19th of March. Share price next 2 days, or actually it was 3 days, just went sideways. That's a really good sign. There was no selling, no extra supply of shares in the market. So I took a position at $1. And this was one of those instances when the share price has not fallen below when I bought. It happens very rarely when that happens. And the share price has just kept on rallying. In fact, it's gone from $1 now to $1.48. So already up 50%, or close to 50% in this position. This is still a trading position. This is not a long-term hold. Now, even though these tailwinds could last quite a few years, eventually I would expect the tailwinds to come to an end, and that's when I'll get out. And the reason I say that is if you have a look at the long-term chart of this company, this is the weekly chart, share price is all over the place. So just based off the weekly chart, this is not a quality company, but this is a company it's in significant tailwinds right now. Now, the same thing is true for IPD Group, with the ticker code IPG. So share price of this company, now the weekly chart looks absolutely stunning, doesn't it? So this is where I bought $1.44 back in February 2022. So we're talking about 2 years ago. And I've yet to sell out my position, not even taking profits. But if you look at the daily chart, share price really doing nothing. In fact, in the past year, actually, since the start of the financial year, the share price has actually gone backwards. Yeah, share price was flat. So it's really not doing anything. I don't understand why people are selling this. It's not expensive. P ratio is like 25. P ratio is 22. Dividend yield is 2.1%. Really good growth in the company. You can see really good revenue growth. I don't understand why anyone will be selling this company right now. I'm not willing to take profits because I think, again, this company is experiencing significant tailwinds behind the company. And they keep mentioning it in their announcements, that sort of thing. That they are experiencing pretty good tailwinds, just like Southern Cross Engineering did that as well. They said, we are facing significant tailwinds. They actually spelled it out in their announcement. We are seeing exploding activity in our sector. And I'm pretty sure IPD groups say the same thing. Now, there could be the case of fund managers selling out. So let's have a look at their investor presentation. No, results for half year. And I'm pretty sure they mention conditions are really good and I expect it to be really good. So there should be an outlook here somewhere. Here we go. The outlook for markets remains buoyant. Well, there you go. Straight away, remains buoyant. The tailwinds from the electrification of the economy continue to have a positive impact, and the group is expecting a number of significant projects to commence in the second half of the year. So just like Southern Cross Electrical Engineering, there's still a lot of tailwinds behind this business. So, and I think maybe some investors think it's overvalued at 22. Don't know about that, but there is no way I'm selling any shares in this company just yet. But I do have $4.20 as a very important level for this company. I might take profits if the share price falls below $4.20 just to preserve my capital, but I won't completely sell out. I'll just take profits at that point in time. Mujadisafajerif, sorry about my pronunciations. I am an idiot white person who can't pronounce any names apart from Anglo-Saxon names like Michael. Anyway, this person says, thanks again for another cracking video. Don't know about that. Good day to be Southern Cross Electrical SXE shareholder. I have a question, RE stop losses, and if you use any trading stop losses for your breakout trading and how you set them up to minimize losses. Okay, so I don't, what's the best word? I do use stop losses, like I just mentioned here. So I do have a price where I would want to maybe take profits or completely sell out. And in fact, I used this on step one just the other day, maybe a week ago or something. So for step one, I had my little stop loss at $1.60, around about that level or so. And then the share price fell below that on the 1st of May, so 10 days ago. So I sold at $1.55. Share price now $1.37. I did not completely sell out. Again, I just took profits because I bought in at 53 cents, took some profits at $1.60 or $1.55, whatever it is. And I'm going to let the other bit run. But I will sell out of my rest of my holdings if I see continued weakness in the share price. So I don't put that stop loss into the system, but I know all the stop losses for all the companies I am trading. And the reason I do that is on occasion, you'll see intraday trading where the share price might fall to your stop loss point, but then the share price will rally during the rest of the day. And this happened to me many, many years ago where I did use stop losses on occasion, on twice, I think it happened, where I was stop lossed out of position. And some would say, well, you had this stop loss too high. No, but sometimes you will see a volatility in a share price and the share price could plunge. And they do know where people put their stop losses. So I do know where the stop losses are. I have a look every single day where the share price is trading in comparison to the stop losses. For instance, Bravura is right on my stop loss. I'm not going to sell just yet because the share price could rally, but I am willing to take profits with Bravura because the share price is right on my stop loss. So I don't actually use stop losses as per se in the system. So in Superhero or Self-Wealth, I don't actually have stop losses, so they know when I want to sell. I do it manually. That's just for me and for various reasons, personal reasons. And a lot of times my stop losses, where I put them, is at important levels, psychological levels. And another thing I'm learning is be a little bit more flexible with my stop losses. So with Bravura, should I take profits if it falls below that level? Because the share price is still in a beautiful uptrend. And this is what I've learned maybe with Hub, maybe. Hub is another one where I've taken profits, share price fell below a level, and the share price then rallied. No, share price didn't fall below $39, but the share price was looking a lot more, volatile. So I just decided to take profits. And I probably shouldn't have done that with Hub 24. It still looks pretty good. So I'm still learning, and that's the main thing. If you stop learning, then what's the point? Okay, so Charles Forthrop has bought some Mayfield Group shares. Hopefully it all goes well. Yeah, so I hope to be in it for the long term, but it is, because it's a small cap company, it is in my trading portfolio. But again, because it's illiquidly traded, I'm going to be a little bit more, I will follow my rules a little bit more loosely with a company like Mayfield Group. It's working really well so far with Shape. What's other companies that are illiquidly traded? Shape, COSOL, Adrad, even Swoop. It's working well. That I'm being a little bit more flexible with my rules for these more illiquidly traded companies. Either Southern Cross, you could say that, and I'm selling out of some of those positions. Not many, I think. Anyway, can you break down or do a breakdown of Biome? I've done a few videos on Biome, Alex W. In fact, Biome almost made it into my top 25 companies, top 25 marked quarterlies, whatever you want to call it. Where is it? That's not it. It's PowerPoint. Biome almost made it. It would have come in at maybe number 26. So I got 25 companies I want to cover. I just had a look at the first company in this list called ReadCloud, and I'm now wishing I did not include that company into this list. I don't like this company much at all for various reasons, but I'm going to stick to my plans and do a video on ReadCloud, because just because I don't like it doesn't mean you can't like it. So Biome is an interesting company. Now, I first did a video. Have a look at the chart first. I first did a video on Biome. In fact, Biome, if I just do this, here we go. So I first did a video, Introduction to Biome, released on June the 5th, 2023. And I've done 2 follow-up videos, January the 10th, 2024, and then a December quarter results on February the 7th. So have a look at some of those videos. Maybe the Introduction Biome video on the 5th of June. Now, I just wish I bought some shares on the 5th of June, 2023, because if we have a look at this chart, you'll see what I mean. 5th of June, 2023. Here it is. Share price at that point was really not doing anything. So have a look at the chart. Share price absolutely not doing anything. In fact, the share price was the nearest all-time low. Share price about 7 cents. 7 cents. Share price broke out, and I was following this company at that point in time. I saw this breakout. I went, should I take a position? I don't know. I don't know. Share price broke out in July, so 1 month after I did that video, at about 9 cents, and a beautiful looking chart. Share price now 31 cents, has been as high as 43 cents back in March. So chart does look a little bit weaker now. There's been a pullback, and a fairly significant pullback. Now, I'm not sure why, but the company, and they sell like, is it probiotic sort of stuff? It's a health stuff they sell. How would they describe themselves? I forget. Microbiome company. They sell products. There's probably a presentation here somewhere. Oh, it's a fairly big presentation, 40 pages long. Oh, that's in conjunction with their quarterly report. So the interesting thing about this company is they on the cusp of making it, of becoming, of growing not growing independently, of becoming self-sufficient. What do I mean by self-sufficient? So receipts to customers, $3 million, operating cash flow positive, $89,000, and very little capital expenditure, $18,000. So that means that's proceeds. So that means this company is free cash flow positive on a low basis, but the company should have grown their cash on hand very slightly, yes. So that means they can grow sufficiently in the future if they maintain being operating cash flow and free cash flow positive, which means they won't have to go to the market to raise more capital, which is very important. And in fact, if they can increase their operating cash flow and free cash flow, they can start giving back up some of that money to the investors as dividends, maybe share buybacks if they think the company is cheap, or to grow, or for growth initiatives to grow the company in the future, which is what they should probably be doing. So I think company is moving in the right direction. What do they sell? Advanced probiotics. There we go. Activated probiotics. And these are stuff I would never buy myself. So Biome Herb Probiotic, Biome Life Probiotic. They had some really interesting products when I looked at it when I did that first video in June 2023. So the company is moving in the right direction. I'm just wondering why the market's a little bit more negative about the company right now. I think there was maybe too much enthusiasm. And the other thing, I've mentioned volume. So let's go back here. We started to see volume spikes in January 2023, and volume precedes price action a lot. There was no volume for like 6 months before that. We started to see spikes in volume. So someone was positioning themselves in Biome shares. And then we've continued to see volume expand. Look at the volume expanding here as the share price moved into an uptrend. So volume is very important. Don't dismiss volume. And we have seen volume decrease as the share price has decreased. That's actually a good sign. I know. So yeah, you can always go back to my history, look at my history and see, or maybe I can only do that. Can you do this? I'm not sure if viewers can do this, but I can have a look at all the videos that I've released on a subject like Biome. 3 videos. Maybe I should leave a link in this video on Biome. I'll try to, but I might forget. Titomic, can you go through your thoughts of the recent Envirosuite results? Growth seems to be growing slowly. Yep, but nothing stand out. I'm starting to get over it and might loss out and move on before June 30. Okay, I will be honest with you. I have been a Envirosuite shareholder in the past, and I became sick of the company, and that's why I sold out. And in fact, every single time I look at an update from the company, I see no reason to even think about getting back in. So third quarter sales update, ARR grows to 62.6 million. I don't care about annual recurring revenue. I want to see cash flow and profitability. And I don't care about new ARR, total ARR. I want to see the company transform that annual recurring revenue into cash flow. And they've yet to show that. And in fact, do they even mention anything about profitability and cash flow in this announcement? No, they don't. Of what I can see very quickly. They talk about sales, new stuff. In fact, they're only talking about ARR. And I don't think this company is even close to being profitable yet. And it's a problem. In fact, let's have a look at Environsuite. Here we go. I like what the company does. I think they have potential, but they just have to realize that potential. And I just, at this point in time, am struggling to see. So really nice growth in revenue, I'm assuming. Yeah, growth in revenue. But the company, let's have a look at profitability and whatnot. Net income, still a huge amount of losses. But what about the cash flow? So have a look at operating cash flow operations. It's still negative, and free cash flow is probably heaps negative as well. It's still operating cash flow and free cash flow negative. So I'm yet to, in fact, there was only one period here where one of those metrics was positive, and that was operating cash flow in the last half year by 0.8 thousand or $800,000. So I'm yet to see anything from this company to shift my opinion about where they're moving. And I think the market is the same. Just based off the share price, 5 cents, significantly lower from when I sold. And the chart is absolutely ugly. So this little brief period where there was excitement in the company, it was false. It was a false. Look at the volume, very little volume. So even this spike in volume was not on the day when share price rallied. So very weak volume on this rally. So when you see weak volume on a rally like this, it's always going to fail. And it failed almost immediately because there's no demand for shares. And there was probably increasing supply of shares, or people wanted to sell because the share price is rallying after a long-term downtrend. And eventually that extra supply of shares just overwhelms. And because there's not enough demand, share price just collapsed like it did. And the chart is an ugly chart. So share price has dropped from its highs back 2 years ago, just over 2 years ago, of 24 cents to 5 cents. It's not a good chart. And markup still 65 million. It's still expensive. Maybe not. it's trading on about 1 times ARR, but ARR, I think, it's becoming clear to me that ARR is an increasingly useless metric. I'm going to say that. Maybe that's controversial, but over the past few years, it's just become increasingly apparent that ARR is a useless metric. If you disagree, I'd love to hear your opinion. Okay, so Environsuite. I've not convinced yet that Environsuite are even close to becoming a viable business moving forward. Good stuff, Kneppy. Be interested in a more detailed analysis of Titomic if you get around it. I actually want to have a look at Titomic. Whatever it's called. Easiest to go to remember, TTT. Yes, I agree with you. I can't even tell you what they do right now. I forget, but it sounded really interesting. And even their pennies 4C and their financials look really interesting as well. Let's have a look at the chart for Titomic. For those who didn't see that video, they released something interesting. I had no idea what the company did. Then I had a look at what the company did. Most of it went over my head, but I went, this sounds really intriguing. Then I looked at the chart. I went, oh, the chart is an amazing looking chart. Absolutely great turnaround story here playing out for Titomic. Do I have this on any watch list? No watch list. I should put this company on a watch list. Bye-bye Australia watch list. So this is what they do, according to TradingView. Metal additive manufacturing, metal coatings and repairs using Titomic kinetic fusion cold spray technology. I'd have to learn much more about that technology because still it went right over my head. Kinetic fusion cold spray technology. But it's been successful, or it is successful based off their financials. Anyway. Okay, working so hard to pan through the rubbish to look for pay dirt. A great look at how to give companies a shakedown. Okay, thank you, David Ress. Great recovery on step 1 last couple of days. Hopefully a panic sell and now roll in the new investors. Thank you, Liam Jones. I don't know. So this is a case where I just don't know, and that's why I did take profits, because I just don't know where the share price is going to go from here. Wouldn't be surprised to see share price bounce. Wouldn't be surprised to see the share price now move into a downtrend. And I have just no idea. But the share price fell below a support level for me. That's why I took profits. But I still maintained 1/3 position just in case the share price rallies from here. But if I see further weakness, I might completely sell out. Not sure what price. I'll have to think about that. But yeah, it's just about protecting capital. And we did see huge volume coming in. On the day, it fell 11.4%. What's happening with step 1? But I think the good times have come to an end for this company just based off what we've seen the last few days. And I think the uptrend is now completed. Maybe. What do you think of IDP education, lowest point after 2020 COVID? Not a big fan of these type of companies, but I have to admit, there is potential. The company was starting to look pretty interesting. What it's called, IEL. So this, I know Rudy Van Villepin-Pack, whatever his name is, was an absolute fan of this company, loved this company. Just because he loves the company doesn't mean you should. And just look at the chart. This is an ugly chart. Share price in a well-defined downtrend. No reason to be owning this company unless you thought it's a high-quality company. And I find it, and I think I would struggle to call this company high quality. Now, market cap 4.6 billion, dividend yield 3.26, price earnings ratio 27.84, even though share price has halved. So share price back in February 2023 was 32, now it's 16, which means the P/E ratio back then was significantly higher. And that's the one thing when I actually had a look at this company was how overvalued it was. I just couldn't believe why people were spruiking up this company when the P/E ratio was so high, like 60. It's like, why? And then as the share price moved into a downtrend, share price fell through this support level and has kept on dropping. Now, is there value in this company now? And just look at this chart. Actually, I said this company maybe is not high quality. Now, if I looked at this chart right there, I would have said this is a high quality company just based on the chart. Now I'm saying no, because this is not the chart of a high quality company. Something's happening to IDP education I don't know what it is. I don't follow this company too closely, but just based off the chart, I would not be interested in this company. The only reason I would be interested in IDP education is if I did more research and I found there was value at current prices. And possibly that is true. If you look at the right, nice growth in revenue the last few years. So I don't know. This is one where I think it's all up to you. Do you think there's value in this company? Because the share price is at multi-year lows, but I just look at this. I find it really weak. I don't see any signs that the downtrend is coming to an end just yet. But eventually, I think value investors will possibly find some value in this company. Okay, my new favorite YouTube channel. I appreciate that. Thanks. That's showbiz. I don't know. Maybe I'm the only channel you look at. And in that case, it is your favorite channel because it's the only one you look at. Sam Bell, very much looking forward to this series. That's the top 25 March quarterly reports. Yes. The first one is Read Cloud, which I should release in the next few days, maybe next 4 or 5 days. Okay, so 9-slide glide says, can someone please tell Perpetual Management that the idea is to maximize shareholder value by watering the flowers and pulling out the weeds? Yes. And not vice versa. Yes. Dumb decision to part ways with the best businesses. Yes. But of course, the CEO will have a great payday. I've also heard that they have to give up the name Perpetual Management. Is that true? I heard this on a podcast today, that parts of this selling off the best part of the business is they have to get rid of the name. How stupid is that? Oh, I can't believe what they're doing. I just find this weird. They're selling off the past part of the business and they're getting rid of the name. I just find it. Why would you be holding shares in this company when they get rid of the best part of the business and they're not going to be named the company? Oh, just a bizarre set of circumstances done by management of this company. Sometimes management of a company aren't doing things in the favor of shareholders, are they? So maximize shareholder value is what they should be doing, but sometimes it seems like they don't care about that. Sean of South Australia has a fairly lengthy comment here. First, I love your commentaries on Twitter. Definitely maintain on Twitter. Yes, okay. If I do find interesting things on Twitter, I will leave those in the rundown videos. Also like to change that honorable mentions are just that. Yes, I think in moving forward, unless it's a big day and there's a lot of really big announcements, I'm just going to maintain the top 5 announcements and maybe just mention companies that just did not make it and not have a look at those companies. Final remark, full employment. This 2023 quote from RBA defines their full employment policy. The government's objective is sustained in inclusive full employment where everyone who wants a job can find one without searching for too long. Generally, as unemployment rates fall, workers are in a better position to demand wage rises. However, rising incomes without corresponding rise in productivity will cause inflation. Okay, I have a slight problem with that second part. And this is my big problem with how we are set up. Well, we're a services country right now, and it's almost impossible to increase productivity when you're a services economy because, well, I'm in services. I create forecasts for the Bureau of Meteorology. It's almost impossible for me to create more forecasts. For me personally, it's up to the organization to increase productivity. So they need to give me some tools to increase my workload, how much work I can do. So it's not up to me, it's up to the companies. And I think a lot of people don't understand that. It's up to organizations and companies to increase productivity. So they need to be incentivized to increase productivity. One of the ways that happens is if people demand higher wages. So the organizations and companies say, well, I don't want to pay this much money in wages. So what I need to do is to implement some more automation or some tools where I don't need as many workers. So companies need to be incentivized to increase productivity. In the past 20 or 30 years, because of lack of demand of wage rises, there's been no incentive for organizations, for companies to increase their productivity or to put in implements or whatever to increase productivity. That's been the problem we have faced over the past 20 to 30 years. The lack of incentives for companies to increase productivity. It's been falling on the worker. In fact, the way companies have increased their profit is by limiting wage rises. That's an absolutely ridiculous way to grow and whatever, prosper. So I do have a problem with that last bit, not your comment, but just the way RBA says that rising incomes without a corresponding rise in productivity will cause inflation. We need companies to be incentivized to increase productivity, and just haven't had that the last, we'll say 30 years or so. And history is littered with occasions where we have seen people given significant wage rises and the companies come back and say, well, we've created this new technique to increase productivity. Industrial Revolution is, I think it was in Scotland, Industrial Revolution is littered with examples of significant advances in productivity because of increase in wage demands. So I think wage rises are very important to increase productivity. But we've got to the point where the government and business want to suppress productivity or wage rises, and that has a really bad effect on productivity. Rant ended. Okay, so Jay Lang says, I should let more winners run for longer, but the problem I have is not having spare cash available to take advantage of new opportunities. We seem to be plentiful at the moment. Let your winners run. Yes, I do find that sometimes is a problem. I have this new opportunity. So it's really good to have a little bit of cash on their hand. But I think eventually, if I am fully invested in my trading portfolio, what I might do is just look at whatever's not performing, just get rid of that and put it into possibly this new one. Possibly sell out of my best position, even though I don't know how to do that. Anyway, so thank you, Jay Lanks. It's a very interesting question. What to do when you have all these opportunities, you don't have the cash? Should you let your winners run more, or should you sell out of your losers and then put that money to work? I think maybe that's the way to move forward. Anderson 637, South African Anderson, South Africa. Is that a bad accent? South Africa. I'm terrible at accents. Thanks for covering Star Entertainment, Magellan, Baby Bunting. Timestamps are invaluable when one needs to go look or pre-look prior comments. I just did my due diligence on Baby Bunting. Now I'm going to go back to glean your previous videos where you touch upon Baby Bunting. That's interesting. Never thought of that. As well as the videos focused solely on Baby Bunting. Okay, so that's just a comment about timestamps. Yes, I'm not going to have a look at Star Entertainment Group, Magellan, Baby Bunting. I think they all look pretty negative right now. Let's have a quick look at the charts. Why not? Why not? SGR still looks negative. Still looks negative. Yeah, I wouldn't even be thinking about this just yet at this point in time. So I'd say over the past year or so, people have thought this is really cheap. So someone probably thought in May last year. We'll go to 11th of May last year. The 11th of May last year, someone probably thought, oh, this company is really cheap. Share price at that point in time, $1.20. Share price now 45 cents. Share price of this company could fall to zero. There's a possibility it could halve from here. Market cap is still 1.28 billion. But I think as it does fall, there's more likelihood there's better value. But I, at this point, just want to remain patient and willing to wait. This could be the low in the share price. I just don't know. That's the way I play it. I just don't know. Magellan, I think this is showing better signs of turning around, has shown better signs. I think maybe this is basing and has reached a bottom, but I need to see a breakout. I'll probably put the breakout level probably there, more of a zone. So definitely above $10. I was trading this, but I got out. It was one of my unsuccessful trades. But I think, yeah, it definitely looked more interesting than Star, and Baby Bunting just released that negative trading update. And at this point, yeah, it's right on. Their last lows we saw right on. So the lows we saw back in February, which is not that long ago, was $1.44. And look at the share price is right now, $1.44. It's right on that low. So share price could drop below that. That would be very bearish. And then the next lows we want to see is about $1.13, which was back in June, I probably could get interested in this company if I saw the share price get to just above $1.10. I could be interested in this company as a value play. Just as a value play, maybe. Thank you, Anderson. Okay, thanks, Debbie, for your tips. I'm AGL and well into the green. Energy is good for me. I am trading AGL. In fact, I didn't double down, but I added to my position. The first time I have done that. The chart looks interesting right now. So I bought on this, I bought on a potential breakout. So share price potentially broke out just above $9. I think I bought just above $9. Now, what was weird about that, share price wasn't at a 6-month high. What I'm looking for is at least a 6-month high. But in this case, I just saw some positive tailwinds in this space, this sector, and I thought AGL Energy might benefit. I wasn't necessarily looking forward to a trading update from the company. And then the company announced a positive trading update or a profit upgrade. And then I bought some more shares at $10 on the 7th of May. And the share price now at $10.27. So both of my positions in this company are currently in the green. And the last time the share price was this high was back in November last year. So not that long ago, but still just on a 6-month high. It's November, yeah, it's 6-month high. So that's AGL. I'm curious to know what you think of the business model for Duxton Water, especially from a long-term macro or meta level of analysis, given your meteorological background and expertise. You won't think much of their chart or their most recent quarterly report, but I was more interested in the long-term viability, especially given recent government initiatives to free up more water for water use entitlements. Share price is hovering near a 52-week low, but RSI and Bollinger Bands are relatively low, suggesting it might be oversold. Yes, I actually do look at RSI for oversold and overbought. Bollinger Bands, I typically look at Bollinger Bands for squeezing, for decreasing volatility, because when you see decreasing volatility, then you see a breakout. But I don't look at Bollinger Bands all that often. Really enjoy the Q&A, and small caps, keep up the good work. I reckon Duxton Water. So yeah, I haven't looked at Duxton Water for many years. This is a really tricky company and really tricky space. Oh, the chart looks, yeah, the chart looks ugly. You're right about that. Although if you look at the weekly chart, this could be a buy the dip situation. We had this period of time back in 2019, 2021. Share price did dip. But their probably share price is the weakest it's been for quite a few years. Not sure why that is. Markup 209 million. Apparently, company has a dividend yield. Price earnings ratio 29.8. I have not followed this company at all. DTO Duxton Water. Yeah, and what you're talking about in regards to water. Okay, water, without doubt, is going to be a much more important resource moving forward. It's a very important resource, but I think it's going to be becoming increasingly important resource. Now, one of the things I'm thinking about, and I'm not a climatologist, I'm a meteorologist, and a lot of people out there who don't know there's a big difference between meteorologists and climatologists. A lot of the climate change skeptics have no idea there's a difference between meteorology and climatology. In fact, I saw one comment on Facebook. If you can't forecast the weather in 100 years, then how are you forecasting or something? No, if you can't forecast my wedding next year, then how can you forecast the weather in 100 years? We're not trying to forecast the weather. It's about climate. And climate's completely different than meteorology. For those who don't know, meteorology is all about weather. Weather, and we can only forecast weather within a week's time. If you see a weather forecast that extends past a week, the chances that weather forecast is going to be accurate becomes infinitely smaller. In fact, weather forecasts are only viable within that week period, because weather it's just really hard to forecast because of all the different factors. We have what's called the primitive models, or the equations, primitive equations, and they take into account what's happening all around the world. And we have these balloons, we have all these weather observations, but they are sampling the conditions in the atmosphere at one point in time, and not completely, because the atmosphere is three-dimensional. And our models, our weather models, take that weather observations, which are significantly incomplete. They could miss something very small that can change. And it's very, because of how it's chaotic, it's chaos theory, that sort of thing. One little difference in the models and the observations could change our forecast or our weather significantly from the models in a week's time. So weather is all about the next week. So that's all I care about, the next week. Climatology is all about the future. And the best way to distinguish between climatology and weather or meteorology is meteorology. And a good way of thinking of this is you go on a vacation and you take all these photos. You take one snapshot, and that snapshot could be of you crying or something. And you might say, that's the weather. At one point in time, that's what your holidays was like. But that does not tell you what the whole holiday was like. Your holiday could have gone for 4 weeks. And if you have a photo album, that will tell you what your holiday was like. That's the climatology. So climatology looks at extremes, highs, lows. So when we talk about climatology in 100 years' time, we're talking about extremes, lows, and highs. And we have a much better predictive, we can do much better with that than just looking at individual days and weather. So climatology and meteorology are completely different. But the reason I went on this little bit of a tangent is, even though I am not an expert in climatology, I'm thinking about this quite a bit lately because of what's happening in the world when it comes to La Nina and El Nino. And we're not thinking enough about how rising sea surface temperatures can significantly change our weather and our climate moving forward. And one of the reasons why I think it's been really rainy, a lot of rainfall, particularly on the East Coast, the last, say, 5 months or so, is because of elevated sea surface temperatures in the Coral Sea. And they have been elevated. And how is that going to affect our weather? Increasing rainfall. And I don't think we really understand that right now. Even climatologists don't understand how that's going to affect our weather. Even the El Ninos, we might see that be less of an issue than these sea surface temperatures. And we know that the temperature or the water reacts much slower than the atmosphere when it comes to temperature changes. And climate change is real, and we are seeing sea surface temperatures rise. And that's going to have an impact on our weather moving forward. And that could mean significantly more rainfall along the East Coast, and maybe water won't be much of an issue moving forward. I don't know. So there's all these different factors when it comes to climate change and water. And I had been thinking for the longest time that water is going to be really scarce in Australia. It's going to be a massive issue. And I'm starting to change my thinking on that. I have no idea what the future holds when it comes to water and climatology, and how we're going to are we going to see our rainfall increase or decrease? I just don't know. That's the problem with climate change. I think we just don't know what the future is going to hold. Anyway, that's all I got. Thoughts on IGO, SPN? Simple enough question. I'm just going to look at charts for both. IGO. That's the weekly chart. So IGO, lithium, and other things. What else do they do? Nickel, copper, cobalt, lithium. This is starting to look a little bit more interesting, IGO. Now, I wouldn't be trading this just yet because we had a high back in March. If we get the share price above, say, 830, 840, that could be a good sign moving forward. The lows, I think, possibly have been reached. A very important level at, what level is that? 675. That goes all the way back. When did I put this line in? All the way back. This might be going all the way back for a long, long time. So this goes all the way back to highs in January 2020, just prior to the COVID-19. That's why I put that line in. That was pre-COVID highs. And it's held strong. In fact, It's worked really well for these lows back in February and February. And that support level has held. It tested it about 4 times and rallied, got very close again in March and rallied off it. So I think there is a chance we might be seeing IGO starting to move into an uptrend. But again, share price of this company is going to be highly important on those commodities it trades. I don't know the mix up or the mix of commodities. Is this company too reliant on lithium? I don't know. Haven't delved that deeply into this company. So I just look at the chart. I just follow the chart, look at the chart, and the chart is starting to look more interesting, but it's not quite there yet. It is turning, but not quite there yet. SPN, Sparc Technology. I'm going to call it Sparc Technology. Sparc with a C. Oh, yes. No idea what this company does. What's it? SPN. What does this company do? I could have a look at this, their website. Why not? Let's have a look at their website. Pioneering new renewable energy technologies in green hydrogen, graphene coatings, and sodium-ion batteries. First, founded in 1984. First thing I think about when I see what they're doing is this is a story stock. So then the next thing I want to do is have a look at whether this company is generating any cash receipts or revenue. So Sparc Hydrogen, Sparc Technologies and graphene, sodium-ion batteries, interesting. So possible interesting stories, no revenues, no receipts, story stock. Okay, so when it comes to a story stock, I don't care about anything else apart from the chart because sentiment is going to drive the company's share price higher or lower. You want positive sentiment behind the company. So at this point in time, did look like sentiment was trying to shift here, and sentiment has gone back to negative. Some good volume coming in, so that could be hopeful that maybe the lows have been reached. So just based on the chart right now, I'm not liking what I'm seeing, apart from some really good volume coming in the last month or so. You can see here, so really low volume, and there was still low volume when the company hit its bottom, share price bottom. So I'm not sure. Market cap 21.47 million. It's too much of a story stock for me. And with these sort of companies, I would not be in it unless I saw some really good positive sentiment. And even then, I'd be looking for my exit signal with a story stock. So you're in it for the short time, for a good time, not for the long term. Unless you knew a lot about that technology and think that they're definitely going to succeed. But I'd say 90% of companies like this, maybe even 95% of companies like this will never succeed. So this would be just a trading stock for me. IGO could be a little bit different because it's a real company, has real receipts, and any shift in sentiment in the lithium space could last for a while, and the share price of IGO could increase by twofold or threefold over any shift in sentiment in the lithium space. Okay, so Jonathan Williams, he's new to investing. I was wondering how come sometimes when I see announcements where profit revenue is all up, however, the price goes down, I assume it is because they were expected to do better. Yes, I'm not completely sure. Additionally, if that is the reason, how do I find their expected results for that quarter year if they are not listed in the announcement? Yes, exactly right. So the way you look at it is, say there's analysis doing a company, and there's all these expectations around the results, and the analysis put all those numbers into their machine to spit out a valuation of the company. And the company comes out and says, well, our results were down, but they were better than expected. So the analysis goes back, puts those news numbers in the machine, and says, oh, our new valuation of this company is now 10% higher than it was. And that's why sometimes you'll see the share price of a company rally, even when you look at the underlying numbers and go, the numbers were down. Why is the share price higher? So it's all about expectations. Now, around that, how do I find their expected results? Which is really interesting. Sometimes a company will have their own guidance, sometimes not. So you need to know analysis. Now, in America, I have found this on the NASDAQ earnings calendar website. So if you go back to one of the days here, so let's go Friday, May the 10th. Now let's go back to Thursday, May the 9th. Now let's go back to Wednesday. I'm trying to find a company everyone knows about. Oh, here's a company called Airbnb. Everyone's heard about this company. And what they've got on this website is the earnings consensus earnings per share forecast. So this is the estimated earnings per share of the company. So let's have a look at Shopify. This is even more important. So Shopify consensus earnings per share forecast for the quarter was 8 cents. They came in with earnings per share of 12 cents. So that was 50% higher than expectations. So right now, you might be thinking, in fact, everybody had the same thing. You might be thinking the share price should have rallied. Did Shopify's share price rally? And the reason I'm showing you this is it did not. In fact, it fell by almost 20%. So what's happened with Shopify? It was not the fact that expectations were better than expected. It was the outlook. So they're actually the experts, the analysis are quite bearish on the future of Shopify during the next, I don't know how many periods, long term. There's no worry about the future of this company. This company will be significantly bigger in the next 5 or 10 years. But the analysis are more concerned with the short term. And they are concerned about the numbers, about weaknesses in this company's sales in the short term. So it wasn't that the results beat expectations. It was more of the outlook. So when you look at the results, it's very important to know if the results beat expectations and or whether the company has released any outlook and whether they're bullish or bearish on that outlook. So it's not about the numbers. It's all about whether results beat expectations or forecasts and any sort of guidance the company has released. Very important. Another way to put it is results, the numbers are the past and the outlook is about the future. And the market is all about the future. Liam Jones, realizing I have already looked at, making fun of, I'm not sure what happened there. We did the same thing, Vol. Not sure what you're talking about there. Darren Symes. Did you sell out of Electro Optics today? No, I did not. I sold out a lot of positions, but not Electro Optics. So let's have a look at the chart for Electro Optics. I've been trading this company, no longer trading, but I do have a longer term position. And in fact, when I say longer term position, so I bought it 86 cents, sold $1.09, bought $1, and then I sold again. I'm going to have to copy this because I haven't put it in here. Sold at, I forget where I sold, something like there, which was a nice little return, 70% return. So why haven't I completely sold out? It's still in an uptrend. So just looking at this, it's still an uptrend. We have seen weakness in the share price, but still an uptrend. And my longer term position is when I sold shares at $10 back in January 2020. Don't know, I have mentioned this before. Not completely, but I sold out of a massive amount of my holdings back in January, February of 2020. I thought the market was completely overvalued. And I thought I'm more willing to put my money into my mortgage. And you can see my mortgage go down from, I think it was like $200,000 to zero in a fairly short period of time. And then the market just collapsed. I was very happy to sell out because there was a podcast I did listen to, and you'll hear some people say, well, it came out of nowhere. We had no idea this was going to happen. It's absolutely BS. If you're paying attention, you could have seen what was going to happen in the rest of the world because of what was happening in China. And this podcast proves it. In fact, this podcast was released when the NASDAQ was at a record high just before COVID-19. In fact, in the podcast, the guy mentioned, in fact, I'll just tell you what the podcast is called. I still have it on. Still have it on my podcast thingy. It was released on the 12th of February 2020, novel Coronavirus COVID-19 Economic Impact with Eric Townsend. This is We Study Billionaires, TIP 282. And it was just an extraordinary podcast because what happened is exactly what he was not fearing, but what he thought. And yeah, he did. They released that podcast when the market was a record high, and he said what was happening in China was really concerning because based off because this is a macroeconomic guy, and he wants to know what's causing this to happen. Why are they building these hospitals in a very short period of time? Why are they building hospitals and closing down whole cities? And he said, if this spreads to the rest of the world, we're screwed, and we're going to have to do the same thing. That's exactly what happened. He didn't think, though. I can't remember whether he mentioned the governments would have to do stimulus or massive amount of stimulus. Can't remember that. Anyway, so I sold out in Electro Optics at $1 or $10, and I just kept my profits. And you can imagine, so I maintained a holding, some shares at $10, and the value of those shares have fallen significantly. That's okay. It's okay. I'm more willing just to maintain that holding for who knows how long. But even if I was just trading that parcel, I probably wouldn't sell out just yet. Share price still in an uptrend. IMPP, next company you should. It's worth $3.59 and it should be selling for $60. What's IMPP? Imperial Petroleum. Let's look at the chart. Well, actually, the chart actually doesn't look that bad. I was going to be really skeptical. Chart actually doesn't look that bad at all. I actually don't mind this chart. I have no idea what this company is. Markup, that's $107 million markup. Does it have, according to this, it has revenue of 183 million and profit of 71 million last year. 2022 had revenue of 97 million and profit of 29 million. Has a PE ratio of 0.1. Something's wrong with this company. Something is going up with this company, Imperial Petroleum. That's really interesting. I've never heard of this company before. It's really small. Whether it's really undervalued, there must be some reason behind this. The chart actually does look interesting. I will give you that much. Thank you, Jared Smith. That's should be selling for 60. Well, based off the PE ratio, you could be right. But what's the best way to say it? It might be cheap for a reason, but what's that reason? That's the most important thing. Hi, Kneppy, P-Woo. Can you look at Quantum's binding information D with adamantium? Which choice would be beneficial to the shareholders? Many thanks. So there's two here. There was one from IPH, and then there was another one from adamantium. Which one's a higher price? So adamantium's was $1.87 or $1.81, I forget. So what's the value of IPH's takeover bid? So it's $1.90. That's a value. But you do get shares, and if IPH shares fall a lot, the value of this takeover bid will actually be lower, while the adamantium, what's the value of this one? Let's have a look. Oh, this is going to take ages. Why is ComSec opening this up much quicker? It's like 250 pages long. Liontown. So what's the value of this one? It's $1.81. So just based off the difference in the valuations, you'd say IPH is a little bit more attractive, but that's also dependent on the share price of IPH. So let's have a look at the share price of IPH. And is there potential for it to fall? Oh, yes, it's in a well-defined downtrend. I don't know. I don't know about this one. And that's, I'm glad I got out. Not glad, but I got out of my trade in quantum intellectual property. Do you have a choice? Is that the question? Do you have a choice? If I had a choice, I probably would go with adamantium because the value is locked in. But how much further has IPH's share price to fall before that becomes less attractive than adamantium? That's another big question. Because the chart is absolutely ugly for IPH. What are your thoughts on Liontown? A few more announcements to go. What's your thoughts on Liontown? Good run this week and approaching production. I bought some shares in Vulcan as a trade. So Vulcan as a trade. So maybe Liontown is another potential trade. So this is Vulcan starting to look positive. Is Liontown starting to look positive as well? It's getting there. It's close, but not quite there. Not quite there just yet. I want to see it get to at least a 6-month high. In fact, it's still well away from the 6-month high. But yeah, not quite there just yet for Liontown. Near production doesn't bother me at all. Not bother, but I don't care about that because in the long run, Liontown share price will move higher with lithium. If lithium does go higher, it should go higher, you'd think, eventually. But lithium could remain at these levels for many, many years. We just don't know. So I just trade these companies and I wouldn't be in either company for the long term. And at this point in time, I just prefer Vulcan just a little bit more than Liontown. Would you take a look at UK market? ASX Investor 4216 says it was just breaking all-time high. What would be likely implications on the rest of the Western markets? Probably none. I'd say no. I don't think there'll be many implications for the rest of the markets around the world. No idea why. Let's have a look at the FTSE 100. Oh, wow. Yeah. Geez. What's the DAX doing? DAX is doing doing really well still. So two of the biggest European markets are looking really good right now. So that's the DAX, which is German. UK or the FTSE is looking really good right now as well. Don't know what's happening. Is this because of some economic conditions in Europe? Haven't really been following what's happening over there, to be honest with you. But it won't have any implications in the rest of the world at all, you would think. You would think, but and again, the economy and the stock market's completely different. These could be running on the back of something that's completely separate from the economy. I don't know, but the in fact, the DAX looks better to me. But yeah, the UK, yeah, the FTSE looks really good as well. What's the Hang Seng looking like? Oh, that looks really good too. Everything's looking good except us. Well, that's not fair. We look okay as well. Nothing wrong there. Thoughts on JB Hi-Fi? They took a beating this week, Thursday and Friday. That's absolutely did. I did mention the company in a video. They released a trading update. The trading update was not that good, and the share price has taken a little bit of a beating. But you can see this massive run, the share price, beautiful uptrend, and I think this is just a bit of a pause. And I am holding JB Hi-Fi for the long term. No reason to sell, in my opinion. Market cap of the company or the dividend or the P ratio is 13.7. It's not too stretched. I don't think the profit will fall all that much. So I think even at these levels, there's value in JB Hi-Fi. Yeah, that's all I'm going to say. Even though the market update was negative, wasn't horrendous. And love your work. Thank you. That's all I got for today's video. If you do have any questions, any thoughts in regards to my next video, my next answer replies video next week. I do work next Friday and Saturday, so I'm not sure what I'm going to do. Maybe I can work from home. Not sure if I'm going to work from home. No idea at this point in time. If I do work from home, I'm going to have to keep the video to less than 1 hour long. If I don't, I might miss next week's answer and reply video. Just haven't figured it out just yet. So if you do have any questions, leave them in the comment section of this video or any other video. If you have any comments, do exactly the same thing. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.